All right. Hey, what's going on, everybody? Lee Boone here, founder of Buckeye Financial LLC, and today I want to talk to you about something that most people spend their entire lives running from. Not because it's hard to understand, not because there's nothing they can do about it, but simply because it makes them uncomfortable. And I'm here to tell you, the conversations you've been avoiding is the most important one you'll have ever. So let's get into it. Real quick, before we dive in, let me tell you who you're talking to and why it matters. My name is Lee Boone, again, and I'm the founder of Buckeye Financial LLC. I've been in the insurance industry and financial service industry for over 20 years. I personally served over 3,000 clients across multiple states: Virginia, Maryland, North Carolina, South Carolina, Arkansas, Texas, Ohio, and Tennessee. That's ever expanding, and it's wherever oftentimes referrals take me. And I specialize in fixed indexed annuities, indexed universal life insurance, hybrid long term care, Medicare, and retirement protection planning. But before all of that, I was a defensive back at the Ohio State University. I was part of the 2002 BCS National Championship team under the great coach Jim Tressel. And what that experience taught me, what winning at the highest level taught me, is that defense wins championships. That's not just a football philosophy, that's a financial philosophy. And everything I do for my clients is built on that foundation: protecting families, preserving legacies, and empowering generations. That's why I'm here. Now let's talk about why you're here. I want to start with something that might sting a little bit, but I'd rather be honest with you now than uncomfortable with you later. You can run from this conversation. A lot of people do. They change the subject. They say, I'll deal with it later. They tell themselves they're too young, too healthy, and too busy. But here's what I know after 2 decades of sitting across from families at some of the hardest moments of their lives, sometimes over the phone, sometimes over video chat, especially these days. The question is never if these things are going to happen. The question is only when. And the longer you wait to face the music, the more expensive the song gets. Every year you delay costs you more in premiums. Every birthday makes you harder to insure. Every health event that happens before you have a plan in place could disqualify you permanently. Time is the one resource you cannot buy back. Uncomfortable conversations make for seamless transitions. The plan you build today is the peace your family feels tomorrow. So let's talk about what we're actually planning for. No matter who you are, there are only a combination of 4 directions you can go in life. And I mean that literally. Path number 1, you leave too soon. Life insurance. Path number 2, you can't do what you did to earn a living. Disability. Path number 3, you're still here, but you need help with the basics of living. Long-term care. And path 4, none of these things touch you, fortunately. Retirement. That's it. Those are your options. Sorry, it's no better punchline, but that's what it is. And here's what's powerful about understanding this. No matter which direction your life goes, there's a product, a plan, and a strategy built specifically for you. Nobody has any excuses to be unprotected. The only variable is whether you choose to act or not. So let's talk about path 1. And I know this is the one people want to skip, but stay with me. Nobody plans to leave early. I've never had a client sit across from me and say, Lee, I think I'm going to die young. Let's plan for it. It doesn't work that way. But what I have seen, more times than I care to count, is what happens to a family when the primary earner is gone and there's no plan in place. The mortgage goes into a default. The savings evaporate within a few years. The kids' futures get redirected. And the surviving spouse, who is already grieving, now has to make financial decisions under the worst possible pressure. 60% of Americans are underinsured or have no life insurance at all. The average family's financial runway after losing the primary earner is about 5, maybe 5.5 years. That's 5.5 years, guys. Life insurance changes all of that. It replaces your income. It eliminates your debt. It funds your children's education. It covers final expenses. And when it's structured correctly, it passes to your family completely tax-free. The right policy doesn't just protect your family when you're gone. Done correctly, with something like an index universal life policy, for an example, it can build cash value you can access while you're still living. But here's the thing. The time to get it is now. Not after a diagnosis, not after a health scare. Now. While you're insurable, while the premiums are low, and while your family still needs you to make this decision. Aside from that, I'll say this. It's almost a red flag when somebody calls me and asks me for life insurance, especially if I've talked to them before. That's a red flag. Now let's talk about, my apologies, okay? Now let's talk about the one that, people almost never think about this. But statistically, it's the one most likely to affect your retirement. And that's path number 2, which is disability. And I'm not just talking about a broken arm or 2-week recovery. I'm talking about the day that comes, and for 1 in 4 workers, it does come, when an illness or an injury prevents you from doing what you do to earn a living. Here's what I want you to understand. Your home is not your biggest asset. Your investments are not your biggest assets either. Your ability to earn income is your biggest asset. Everything else was built on the foundation of your paycheck. And if that paycheck stops, the mortgage doesn't stop. The car note doesn't stop. The groceries don't stop. Your bills don't care why you're not working. There are 3 types of coverage that matters here. You have short-term disability that covers you when something sidelines you for weeks or months. You have long-term disability that covers you when it's years or permanent. And own occupation coverage, which is the gold standard, covers you if you can't perform your specific job, even if you could technically do other work. Now, 1 in 4 workers will experience a disability before they retire. Is your income protected? Path number 3 is the one that sneaks up on people the most, because it's not about dying, it's about living longer than your independence allows. Long-term care is what happens when you get to the point in your life where some of the basic core things you've done for yourself your whole life, you can no longer do them on your own. The insurance industry measures this through what we call the activities of daily living. And there's 6 of them. There's bathing, dressing, eating, toileting, transferring, and continence. When 2 out of 6 are impaired, that's when long-term care benefits activate. And here's the number that should get your attention. 70% of Americans over the age of 65 will need some form of long-term care. 70%. That's not a fringe scenario. That is the expected outcome for most people who live a full life. And then the average cost of long-term care runs between $54,000 and $108,000 a year. And the average duration of care is 3 to 5 years. You do the math. Without a plan, the cost comes directly out of your savings, your home equity, and your children's inheritance. With a plan, it comes out of your policy, and you put the policy in place before you need it. Now, I want to go a little deeper on a long-term care because this is where most people have misconceptions. When people hear long-term care, they immediately picture a nursing home and they think, well, I've got family, my kids will take care of me, or I'll just stay home. I don't need a facility. And here's what the right long-term care plan actually does. It adapts to your reality. If you have family willing to step in as caregivers, a well-structured policy can actually reimburse those family members for the care they provide. Because here's the truth. Caregiver burnout is real. And when love turns into obligation without compensation, sacrifice can start to feel like resentment. A good plan protects that relationship. If you want to stay home, in care is absolutely an option. A skilled aide comes to you. They help with bathing, meals, medications, management, daily support. You keep your independence, your privacy, and your routine. In a facility, if a facility becomes the safest option, whether that's assisted living or a skilled nursing facility, your policy covers it. Without coverage, the quality of your care is directly tied to how much money you have left. With coverage, you choose. And if you have no family support available, this is even more critical. Without a plan, someone else makes decisions about your care. With the plan, you decide. The provider, the setting, the standard of your own care. Part-time or full-time. A well-structured policy adapts to the need, not the other way around. Now here's where it gets interesting. Some people don't want to talk about death. That's fine. I understand that. But if you don't want to talk about death, you absolutely have to talk about life. Because path 4 is this. None of those other things touched you. You didn't die early. You didn't become disabled. You didn't need long-term care. You made it. You got to retirement. Now what? Because here's what most people don't realize. Making it to retirement without a plan is its own kind of financial emergency. There are 5 risks that will attack your retirement if you let them. You have market risk, a crashing at the wrong time. Early into your retirement can permanently damage your income stream. It's called sequence of returns risk, and it's devastating. Longevity risk. Living to 90 is a blessing, unless the money runs out at 78. You have tax risk. The IRS have a claim on every dollar you've got sitting in the 401k or the IRA. You've been deferring the tax your whole career. Retirement is when the bill comes due. You have healthcare risk. The average couple will spend over $300,000 on healthcare costs in retirement. Medicare helps. It does not cover everything. Inflation. Look, $5,000 today will not buy the same life in 20 years. Your income needs to grow with the cost of living. A fixed indexed annuity addresses all of these. Growth tied to the market index, principal protection so you can't lose what you put in, and a guaranteed income stream that lasts as long as you live, no matter how long that is. Now I want to make this real simple for you. A healthy 30-year-old male can get $500,000 in life insurance for around $20 a month. That same policy for a 40-year-old is about $55 a month. And at 50, if you're still insurable, you're looking at $150 a month or more. A hybrid long-term care policy purchased at 45 costs dramatically less than the same policy purchased at 55. We're talking 2 to 3 times higher premiums for the exact same coverage. Health determines eligibility. Age determines cost. And every year you wait, you're gambling with both. Time is the one resource you cannot buy back. The best time to have had this plan in place was 10 years ago. The second best time is right now.